Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about the purpose of investing. But before we do, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. So, what is the purpose of investing? I love having this conversation with folks because a lot of times they haven't really have their mind around what they're actually trying to do with their money. So when I'm talking to somebody who's say 25 and they're asking me how much do I need to put away, it's like, well, the standard answer is put away at least 10% of your salary or income, or if you really want to kind of get on top of things, 15%. For somebody in their 40 range, I might say, hey, you need to be maxing out. Basically save whatever you can because retirement's that much closer. But sometimes what can be lost in the technical aspect of investing is what it is we're actually trying to do with our money. So I'd like to throw out some concepts here about it's looking it through this lens. So think of three periods of your life. There's when you're young. That's kind of when you're working for the purposes of this example. Then there's your adult phase, which is now you're kind of the peak profession, having kids, if that's your path. And then there's the retired phase. So, which is after you finished your profession and now you're off into your retired years. So think of it like this. There's three things that everybody has, and that's time, energy, and money. So when you're young, you have both time and energy, but you don't have any money. As you transition to an adult, you have energy and money, but no time. And then when you're retired, you have money and time, but no energy. So it's a really good way to kind of get your mind around what you're doing with the going from being young and broke to being retired and wealthy, but then maybe not have the energy to go out and do all that stuff. So that's how you kind of manage that whole investing purpose, is to get you to the point where you have enough money so you can try to enjoy it, but still have enough to make sure it lasts longer than you do. So the short answer when folks ask me, what is the purpose of investing? Is I say, well, it's to make sure that we have enough, which is different for everybody. Absolutely. What's enough for you is different for what's enough for me, or somebody that's, if you've heard of the FIRE movement, which is financial independence, retire early, which everybody's different, but largely looking to leave the workforce in 30s and 40s with enough money to kind of live a very basic lifestyle, but that money lasts a long time, versus somebody who's looking to get super wealthy and maybe generate multi-generational wealth kind of numbers. So it's different for everybody. But when you think of what's the purpose is to have enough, well, think about what your retirement's going to look like. And when I say have enough, that really means enough to replace your income. So when you hit retirement, you're going to have either you have a pension, which again is not that common anymore. I'm very fortunate in the fact that I earned one in my military career. But if you have a pension, then there's a certain amount of money coming in the door. But you may not have that. So you might have Social Security as your only form. If you're either single, you'll have yours. As a couple, you'll have two Social Securities coming in, depending on ages and what time you claim and all of that. But eventually you'll have two income streams there, one for each person of Social Security. And then you need to use your portfolio to cover the gap. So to generate that income, and you may have some part-time work in there. Some people work their entire lives, and that's okay. That counts too, whether they do it out because they want to or out of necessity. Either way, that means money's coming in, and then you have to have money coming in off of your portfolio. So that's really the purpose, is to kind of think ahead in time to how much money I'm going to need in retirement. And then that becomes the number that your portfolio needs to grow to over time. And then to stay on time, on target, you need to take a look at where you are at current age and what size your portfolio is or your net worth is, and then make sure you're doing all the steps to ensure that you get to that number so it can in turn replace your income. So I'll give you a quick math example. So if you need $100,000 to live on, So if you have a pension and Social Security, and say that adds up to 60,000, adding the pension and possibly two Social Securities, or maybe even two pensions if you're very fortunate. Say all that adds up to $60,000. That means your income gap that you need to replace now is $40,000 to maintain that $100,000 a year lifestyle through your retirement. So in that case, since the gap is 40,000, you would need basically $1,000,000 if you use the 4% rule, which you can argue 4% or 5%, however you want to, but in this scenario, I'll use 4%. That means you basically need $1,000,000 portfolio. So you think over the course of a lifetime, if I save 10 to 15% and I started early, that will probably get you to that ballpark. Now, the second example, so first example is your pension, Social Securities add up to 60,000, you need to replace 40. In the second example, say you don't have a pension and your Social Security, either just yours or the couple's total Social Security adds up to $20,000. Well, in that case, you need $80,000 of replacement income. And to get $80,000 of replacement income using the 4% rule, you would need a portfolio of $2 million. So that's a big change on how you live your life while you're in the workforce. On, do I need to just save maybe 8 to 10% to get to that $1 million level because that's going to be enough from what I project? Or is it the, hey, I don't have a pension, I need to now really save and invest because I need basically my number, if you will, is now that 2 million when I'm in my 60s, and that's obviously twice as hard as getting 1 million. So really kind of knowing where you're going can help you back that up to a day-to-day philosophy of what you need to be doing to stay on time, on target right now. So that's the purpose of investing. And I want to clarify the difference between investing and gambling, because I do talk to some folks, and I see this, of course, on Facebook, where everyone is a genius and qualified to comment on everything, is that some people think, hey, Wall Street is a big casino. The stock market is a casino. It's all rigged. It's just rich people making money, blah, 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 blah. Other people, like myself and many others out there, will say that the stock market is the greatest wealth building tool ever known to humankind, because it allows you to jump straight from being an employee where you make maybe an hourly rate and you would normally work your way up to like shift manager, and then maybe the overall manager, and then maybe a district manager, and then eventually to an owner. Instead of taking the decades that it takes for you to go from employee to owner, you get to circumvent all of that by becoming an owner right away. So I can simply, even though I may work at Whataburger flipping burgers, I can buy a share of Apple. And one share of Apple stock means I am actually a part owner of Apple, the company. And I hold that share for 40 to 50 years if you're a buy and hold person. I've had part ownership of that company forever. I get part of the profits forever. I'm getting a dividend. I get the capital appreciation. It allows you to skip all of that. So that's why it's the greatest wealth building machine known to humankind. It really is. But yet there are those that are convinced that it's gambling. And I'll explain the difference between the two right now. Okay, let's start with definitions. So it's important to start there, then we can talk about reality. So investing by definition, and whenever I sit down to talk to especially young folks, I beat this point home with them, is investing is the allocation of capital with the probability of gain and the possibility of loss. So think about that: probability of gain, possibility of loss. In terms of expected value, if you've had your statistics class and you remember any of them, that means you have a positive EV, positive expected value, meaning you will probably make money, but it is possible that you lose money. Gambling is the exact opposite. So it's the allocation of capital with the probability of loss and possibility of gain. So when you think casinos, Las Vegas, slot machines, blackjack, craps, lotteries, scratch off tickets at your local gas station if it's legal in your state, those are all gambles. That's gambling. That's not investing. Taking your paycheck and getting cash for it on Friday and going to get some scratch offs is not an investment plan. That's gambling. So you have to know the difference. So investing is a very slow process. It takes a lot of patience and discipline. You should have a strategy. At the beginning, your strategy isn't necessarily all that important. It's get started, get some money into your 401k or thrift savings plan or 403b or your IRAs. It's kind of at the beginning, it's just get started. And then your strategy, as you get to that 6-figure point on into the 7th figure, that's when you really need to kind of figure out what your strategy is. But at the beginning, it's just get started. I was very fortunate. I started when I was 16, and that paid off. And I mean, it's amazing. But you have a strategy when you're investing, and then you make adjustments along the way based on how your investments are working or not working. Gambling is just trying to get rich quick. It's impatient, it's undisciplined, it can be haphazard. And when I'm talking to investors and somebody starts throwing out, hey, I read in a newsletter, which is red flag number one, they bought a newsletter, which is basically, if you look at read the disclaimer on a newsletter sometime, if you're one of these that pays for them. I'm glad you're interested. I'm glad you want to learn more, but read the disclaimer. They're not financial advisors. They don't have any licenses. They don't have any certifications. They publish a newsletter and you buy it, so they can really say anything they want. And often they will try to direct you into penny stocks because, and they can't lie to you. They have to tell the truth. But the one time they bought this penny stock and it went up 30,000%. They don't mention that for the past 20 years, they actually have lost money. They only tell you about the one time that you win. So it's kind of like having the lottery winner on TV. It's like putting the slot machine jackpot winner's picture on the wall, because when you see it, you resonate with that and you're like, that could be me. Well, that's a get rich quick mentality. So if somebody approaches me and says, hey, Steve, I want you to put me in I want to take a look at a bunch of penny stocks. And it's like, well, are you investing or gambling? What's your investment thesis? And the investment thesis is, well, it could go from 3 cents to $30 and I would make that much money. It's like, that's not a thesis. It's like, what's the business about? What do you know about it? How does it make money? Does it make money? Most penny stocks don't yet. But what's the long-term plan? How's the leadership? Those sort of things. Excuse me. Those sort of things you ask when you're an investor. You don't ask when you're a gambler. You just buy it and you throw it in the portfolio and say, I hope it hits, right? So know the difference between the two. But I'll close with this. The purpose of investing is obviously to make sure we have enough. So when you look at each investment, and this applies not just to stock market, but when you buy a house, whether it's your primary home or an investment property, look at through the lens of an investor. Meaning, what's the risk reward ratio at play here? That's why a lot of people like real estate, and I like real estate too. You don't have the massive upside that the stock market can give you, but you certainly have fantastic upside, and there's very little downside. I happen to live in Austin, so it's a booming housing market. It has been for years. That may or may not continue, but it's certainly projecting like it will. So when I pay X number of dollars for a house, or you say you buy a stock or you buy an index fund, the first thing you need to think of is, how much can I lose? That's what a professional does. That means your head's on straight is you go, okay, how much can I lose in this investment? And when you look at a housing situation, a lot of times there's very little downside in booming markets. Yes, 2007 and 2009 took down all markets, but that was rare. And if you could hold through that, then you were fine. If you were, at that point where you had to move, possibly you got burned, and largely it wasn't your fault. It just kind of happened. But you want to look at it from a risk reward. So what am I risking? How much can I lose? And then think of how much you can gain. If you're solely focused on the gain, you probably have more of your gambling hat on than you do your investor hat. So make sure you have it clear in your mind. And if you look at anything, if it's not positive expected value, it's not an investment. It's actually a gamble. So make sure you have that squared away. So that's what I've got for today's show. Please reach out through ototnow.com with any questions or comments. Thanks again for listening. And here's to you fighting the good fight every day to be on time, on target with your goals.